Hey guys, welcome or welcome back. Coupang stock was up almost 11% today, so I wanted to get you an update on that, let you know what the narrative is in the market for why the stock was up so much. And also, I'd like to get you an updated Campbell's valuation because I've been covering both of these stocks on the channel. If you haven't seen my other videos on Coupang, you might want to go check those out. In the last one I did, where I also talked about booking holdings, I gave valuation models, or I gave a valuation model for Coupang. And I think I gave a valuation model for booking holdings as well, actually. So go check that video out. And then in the video I did before that, I talked more about the business of Coupang and also explained how it reminded me of the salad oil scandal that led to Warren Buffett buying American Express stock. So go check those videos out if you haven't seen those yet. But uh, Coupang, why was it up so much today? There was a very significant insider buy recently. You can see here Neil Mehta. I'm not sure how to pronounce his last name. He purchased a lot of shares. Here's the actual SEC filing, so you can take a look at that if you want to. But he made a significant insider purchase, which is signaling to investors confidence that insiders are optimistic about how the company's doing or how things are going to go in the future, thinking that the stock is undervalued. This was great for me because I've also been buying Coupang stock fairly recently, and actually fairly recently added a couple of call options as well, which, as you can imagine, those did quite well today. They had been down some, but they recovered quite nicely today. So hopefully this is the start of a more significant uptrend. So another reason why the stock was up today, this favorable macro shift. So with the situation going on in the Strait of Hormuz, there's started to be some optimism that maybe, the strait could open up a bit. And so that obviously has implications for a country like Coupang that's going to have shipping costs, that does business in South Korea. And so we can see here, crude oil sinks on signals from Strait of Hormuz. You can see the time here, the timestamp. But U.S. crude oil futures settled down 5.3% to $93.50 a barrel. That's as the world is getting signals that Iran is letting some tankers through the Strait of Hormuz. So this obviously was a positive for the market today. I'm not sure how much of this really was the the thing that really impacted this versus the insider buy, but I'm sure it didn't hurt. And then finally, the stock was just getting really oversold. So as we can see here, the stock is just down significantly since the high that it made back in September. So this significant sell-off here, and the fact that the stock just became so oversold. If we look at this in the weekly RSI, you can see the weekly RSI is still 40.82. So a lot of room to run here on the weekly RSI before you'd even really start to think that this was even approaching anywhere near being bought back up. So still quite sold off here, as you can see. So all of these factors together combine, see a nice jump in the stock price today, which is always good to see. Aside from that, I also wanted to get you an update on the Campbell's valuation. So we looked at the I looked at the earnings report last week. So here we have the DCF model. I'm assuming a little more than 4% revenue decline in fiscal year 2026, and then 1% decline in fiscal year 2027. And then I'm assuming they can get back to 1% growth beyond that. And I also have that 1% as the perpetual growth rate here. I am assuming some margin improvement as they go forward, as you can see here, and I can actually zoom in a bit on this so you can see these numbers a little bit better. But I am assuming some margin improvement over time here. If you look back at some of the past margins they've done, they've done higher margins in the past. The business has changed with some acquisitions and things over time as well, but I am assuming that they can at least get back to 6.5% net income margins. I think that's pretty realistic, especially when you consider it'll only help as they pay their debt down more. And another thing that nobody's really talking about with these consumer staples companies is I could see them become beneficiaries of robotics and AI as well. And that's not really being priced into these yet, I don't believe, with how much they're selling off. So that's another thing to think about. But they are working on trying to do some cost savings and things, so that should only improve the margins. So I am assuming they can get this eventually over time back to 6.5%. In terms of my stock-based compensation adjusted free cash flow numbers. You can see the assumptions I have here each year. You can see how eventually I have this ending up in line with the net income numbers over time, that eventually ending up being in line there. And I've calculated a weighted average cost of capital of 5.39%. You might say that's a low number. I agree that is a low discount rate here as the required rate of return, but I did factor in the difference between enterprise value and market cap and subtracted that difference from the future free cash flows. So I am accounting for them eventually having to pay back that debt. So I don't think having that low weighted average cost of capital number really is unfair necessarily. I did use a beta of 0.59, which is the beta for XLP, which is the consumer staples. It's a consumer staples ETF. The reason I did that is because Campbell's, they have a negative beta when you look. So that basically means that the stock is, moves in the opposite direction of the market. If a stock has a beta greater than 1, that means it's more volatile than the market. If it's less than 1, it's less volatile than the market. Campbell's is actually negative, which means it moves opposite of the market to some extent. I didn't think that using a negative beta made sense for this, and so I did go with that sector ETF beta for this. And so these are the numbers I used to get that discount rate. And I get a fair value of equity of $35.32 a share. As you may be aware, I mean, 21.39, it looks like this closed at today. Yeah, 21.39. So quite below that fair value. Even if you want to use a 7% discount rate instead of that weighted average cost of capital as your discount rate, you're still getting a fair value of $24.36 a share. So yeah, Campbell's has some struggles. As I talked about in the last video, I want to see them grow their net income margin. I want to see the company get back to growing the top line. They've got to pay their debt down. There are some things here working against them, but I do think that the stock is undervalued right now. It's very oversold. If we look at the chart on this, the stock is oversold on the monthly chart. You're talking about, we're trading at levels right now with this stock that haven't been seen since 2003. It looks like here. So the stock is very has been very sold off. So overall, I do think despite the challenges they're facing, the stock is undervalued right now. So I'm just going to continue to hold my shares, I believe. I'm not sure yet what I want to do with my call options. I'm still kind of thinking about that. But my shares, I'm just going to continue to hold for the time being. I'd be interested to hear what you think about these stocks. Are you bullish on Coupang? Do you think Campbell's is going to find a bottom soon? Let me know down in the comments. I'm really interested in what you have to say on these. I don't necessarily, until we see some momentum from Campbell's, I'm not going to be surprised if there's just more downside, but I do think that the stock is undervalued here. Hey, if you found this video helpful or informative at all, please click the like button, subscribe, click the bell to get notifications, and follow me over on X at Stock Sale Flyer, where I give more updates and thoughts in the market. As always, I really do appreciate all your support. Thank you again, and take care. Bye.